Chapter 7, Question 16a. Alright, so in this situation, we've got a company called Wicked Kitchen Supplies for the month of March 2019. We have a number of transactions, and we're asked to journal them using a perpetual inventory system, and we're rounding all calculations to the nearest dollar. The first item that we're given is March 1st, they purchased inventory for $16,000 on credit from a company called Hotel Supplies, terms 120 net 30. So the first part of the transaction then is to record the fact that we now owe Hotel Supplies the $16,000. And we've set that up as a credit to accounts payable and a debit to our merchandise inventory. The next step says is we then paid $35 to have the merchandise from Hotel Supplies delivered. So we were responsible for that charge. So we will debit the increased cost of our inventory for the $35 because it's actually part of the inventory cost with a credit to cash because we paid it in cash. The third item says we sold merchandise on March 5th to Four Boars Restaurant for $8,000 with terms 210 net 30 and the cost of goods sold were $5,500. This is a two-part transaction. The first part we will debit accounts receivable for Four Boars Restaurant for $8,000. We will credit sales revenue for $8,000 for that inventory sold on account. The secondary part of this transaction will be to record the cost of goods sold. We were told that it's $5,500. That will result in a debit to cost of goods sold and a credit to reduce the value of our merchandise inventory for $5,500. March 5th, it says we paid $25 to ship the goods to Four Boars Restaurant. So in this situation, we paid this cost. We need to debit shipping expense and credit cash for $25 for the shipping costs that we paid. Next, it says March 8th, Four Boars returned $1,900 sales price worth of merchandise purchased on March 5th. The cost of goods sold was $800, and there's nothing wrong with it. So in this situation, we need to, first of all, set up the fact that they have returned items. So on March 8th, we've got a $1,900 debit to sales returns and the offsetting credit to accounts receivable. This customer has not yet paid for this invoice. Also, we are returning the inventory or the items back to inventory. So it's a debit to merchandise inventory and a credit to the cost of goods sold to reduce the fact that we now have these items back in our possession to resell to another customer. March 12th, we returned $500 of the merchandise purchased on March 1st as it was the wrong design. We have not paid this invoice yet. So therefore, on this date, March 12th, we need to reduce our accounts payable because we owe less to our vendor, a $500 debit to AP, and a reduction in our inventory for $500 because we have less to sell now. March 15th, it says we received payment from Four Boars Restaurant for the March 5th sale. Now in this situation, we need to do a little calculation. They bought some items and they returned some items as well. They paid on March 15th for March 5th. March 5th, they said that they had a discount within 10 days. It is exactly 10 days. So we need to determine what the discount is. In order to do so, we need to identify the fact that they purchased $8,000. They returned $1,900. So their net amount owing to us is $6,100. With a 2% discount, that will calculate an amount of $122 that they will not pay. So in this situation, the cash we're getting is $122 less than the AR. So we need to clean out the AR for this customer of $6,100, so a credit to AR. The cash is less the discount of $122, resulting in a debit to cash for $5,978. March 15th, we pay for the merchandise purchased from Hotel Supplies on March 1st, which had a discount if paid within 20 days. It's only been 14. So similar to when we collect money from customers, when we pay vendors within a discount period, we need to calculate what that discount would be. We originally purchased $16,000. We returned $500, which means our net owing was $15,500, with a 1% discount resulting in $155. So for this transaction then, we need to remove the entire accounts payable of $15,500, so debit to AP, a credit to reduce the value of our merchandise inventory for that discount of $155, and a credit to cash for the amount that we're actually sending to that vendor of $15,345. Next transaction says March 23rd, we sold merchandise on credit to Black Kettle Kitchen for $4,000. Cost of goods sold was $2,000. So in this situation, we need to debit AR for $4,000 with a credit to sales revenue for $4,000. Secondary part of the transaction has to record our cost of goods sold, being a debit of $2,000 and a credit to our merchandise inventory of $2,000 as well. March 26th, Black Kettle Kitchen returned $200 sales price of merchandise purchased, and the cost of goods sold was $50, and the merchandise was returned to inventory. So similar to the other situation, we need to debit sales returns and allowances for $200 with a reduction to AR, a credit for $200. And we need to return the items back to inventory. Their cost was $50, so it's a credit to cost of goods sold to reduce those items, with a debit back to inventory to add them back available for sale. The next item says March 31st, we received payment from Black Kettle Kitchen for the March 23rd sale. So in this situation, we need to determine what they actually paid us. Similar to before, they purchased $4,000, they returned $200, their net amount owing is $3,800, with a 2% discount resulting in $76 in sales discounts. So in this situation, we need to reduce our AR for the total amount owing of $3,800, record the sales discount as a debit for $76, and our cash coming in the door is only $3,724. Alright, so the next part of this problem says to calculate Wicked Kitchen Supply's gross profit for the month. I've already displayed it on screen, but I'll just walk you through it briefly. So gross profit is equal to the net sales less the cost of goods sold. Net sales has three components to it in this situation. We have our sales revenue, less our sales return and allowances, less any sales discounts. So if you look through our transactions for the month, we have two sales being $8,000 on March 5th and $4,000 on March 23rd. We had two returns being $1,900 on March 8th and $200 on March 26th. And for sales discounts, we had two sales discounts being $122 on March 15th and $76 on, oh, I have the wrong date there, I apologize, on March 31st. So if you add up the 8 plus 4, take away the returns and discounts, you'll have a net sales amount for this organization of $9,702. The next part is to calculate the cost of goods sold. Cost of goods sold, you need to reflect all the transactions for the month. So we have $5,500 on March 5th. We have less $800 on March 8th for some returns. We have March 23rd for $2,000, less some returns again on March 26th for $50, for a total of $6,650 for the month. Then in order to calculate gross profit, then we take the $9,702 less the $6,650 for a total gross profit for Wicked Kitchen Supplies for this month of $3,052. I hope you found this helpful.